boy, ladies and gentlemen, welcome back to the channel. We have all of the information that you need to know to be ready for this upcoming trading week. All of your economic data, all of your Fed speakers, the technical overview of where we are at in the markets. And let me just tell you right now, over half of hedge fund institutional investors think the markets have run too far, too fast. They're expecting a pullback. Any reason to give the markets a correction? You likely get a correction. This week, you could get quite a few reasons for a correction, and I'll go over my expectations as well for this week in this video. With that said, hit the like button and subscribe to the channel because it's free 99. It costs you absolutely nothing to do so. In fact, it costs less than breathing oxygen these days. You're taxed on this, taxed on that. That's a fee. That's a fee. Nope. Like button. Hit that subscribe button. Free 99, cost you absolutely nothing. So first up, pretty general. As I said, about 61% of hedge fund institutional money managers believe Q1 was a little bit too aggressive to the upside, and they're looking forward to a correction in the markets. I want to be very open and honest with you up front. The word correction implies correcting something, unless I misunderstood the English language. Correction, well, it doesn't necessarily mean that everything needs to correct. If some areas have already seen a correction, like small caps and interest rate sensitive names, the stocks that really did not participate in this market so far in 2024, those are probably not the areas that are needing a correction. Nvidia, SMCI, AI stocks, big tech, those areas could definitely see a correction. The difference between a broad market correction, a broad sell-off, or a quote-unquote correction could be the way that the markets correct. If we get bad news, a bad catalyst, then you could see everything sell off. But what we've seen towards the end of Q1, the last couple of days of trading, was selling of big tech and that money going into the Russell 2000. So you already started to see a little bit of a correction. Now, if any of your big tech names or AI stocks have bad news, obviously that could spur a larger correction quicker, but it would not surprise me to see an overall kind of sell-off in some of your names that have rallied aggressive. Now, an Apple, a Google, an Amazon, a Microsoft, Nvidia, some of these stocks, they have large weightings in the S&P and the NASDAQ. So it's possible you could see a sell-off in some of those names that arguably need a correction, and that could send the S&P and the NASDAQ lower. But at the same time, you could see a broad market participation to the upside, and it really wouldn't be reflected in the broader indexes. And I think that is a very real possibility going ahead. Let's be honest. The Fed is our friend. The economy is holding up. There's not a lot of reasoning for a correction. And if anything, the Fed is now our friend. They're going to be cutting rates. And let's be honest, Fed Jerome Powell is begging for a reason to start cutting rates. That should be positive for interest rate sensitive names and small cap companies, but it has not been positive so far in 2024. Your small cap stocks are actually negative so far on the year, whereas the S&P and the NASDAQ are up 10%, yet the Fed is going to be cutting rates into a relatively strong economy. That sounds like a backdrop that should be good for interest rate sensitive small cap stocks. So I think you probably get capital going into that area of the markets. Regardless, if you do start to see a pullback in the indexes, that could just amplify this rotation that you've started to see over the last couple of days. And you do have a little bit more of that portfolio rebalancing that could take place here in this upcoming week. That's really when, let's say, a hedge fund, for an example, they're market weighted to the S&P. So let's say, 50% of their portfolio is weighted to the S&P. Apple's 10% roughly, right? Microsoft, another 10% or so. Or I'm thinking of the NASDAQ, doesn't matter. But let's say Microsoft did very well in Q1. Now it's 13% of the index. They have to go ahead and reduce that back to 10%, take some gains, redeploy that money elsewhere into the markets. That is the beta following the S&P. The alpha is trying to outperform the S&P. Those are going to be your Russell, your small cap stocks, some of your other maybe higher flying, less concentrated positions. That could be a Crocs, that could be SoFi, that could be any other stock out there, right? To try to get alpha and beat the markets. You likely see hedge funds and institutions kind of get back to a beta in some of their core positions, big tech, think big tech, and add to their alpha to try to spread out some of the concentration that their portfolios are currently seeing. In other words, that also could be good for small cap stocks and interest rate sensitive names. So first up, when we take a look at the economic calendar, the first bit of data starts on Monday. You have ISM manufacturing PMI. What a good birthday present that is for myself. It is my birthday, yes. So there's two major events happening. The birthday and the ISM manufacturing PMI. This number is expected to come in at about 48.4. Last month was 47.8. Keep in mind, the markets want to see a strong economy. They want to see a consumer that is able to spend money, even if it's on credit, even if you got those credit cards and you're swiping them. The markets, they still want to see that. They want to see spending because what? Consumers having jobs, spending money, drives earnings growth, which justifies valuations where they are. If you start to see earnings coming in weak or estimates falling even more than they already have in 2024, that's going to be problematic. And I think that's, I guess, one of the catalysts that could give the broad markets a sell-off. If earnings estimates start to fall based on a presumed weaker consumer throughout 2024, and maybe, just maybe, we get some of that fear towards the end of the week in some of this data. But nonetheless, that's what we have for Monday. You have Fed Cook that speaks at 6:50 p.m. after the markets are closed. Probably not going to be a big deal, but also keep in mind, at the last Fed meeting, Fed officials got a lot more bearish than they were before. Less cuts in 2025, less cuts in 2026. The neutral rate, the longer-term neutral rate, went up for the first time in forever, basically, and in like decades, right? That was not good. Markets didn't care. Take a look at what is highlighted here in blue. You can see back in December, the Fed official with the lowest estimates for the federal funds rate by the end of 2024 was 3.9%. That jumped up to 4.4%. That was a 50 basis point increase, a 0.5% increase on the most dovish, most bullish Fed official there is. That's pretty negative, right? That just a change of 50 basis points on the most dovish Fed officials projection. I think that was a little bit more bearish than the markets took it. After all, I think the algorithms just traded off of this 3 projected cuts in 2024. But again, if that is true, then small cap stocks should have a pretty good backdrop to start performing better and maybe help fuel a larger correction in your big tech names, because after all, the Fed, cutting rates 3 times, 2 times, 1 time, 5, 10 times, it doesn't really matter for big tech. They're going to do what they're going to do. Their business is not reliant on cuts. It's not really going to benefit from cuts either. Tuesday, you have your big data coming out with the JOLTS job openings. You're expecting 8.79 million job openings. Last month came in at 8.86 million job openings. So the deal here is, if you have, let's say, a Dollar General looking to hire 5 employees, that's great. The Dollar General is probably doing well. Same thing for a restaurant, for that matter. If you cut that down to 2, presumably the Dollar General is not doing as well, or the restaurant is not doing as well. If you're starting to lay people off, well, that's obviously not great. So JOLTS job openings just measure the amount of job openings out there in the economy. If you were to see these start to fall, that's typically not a good sign, right? And you are expecting them to fall a little bit. But if you fall like 500,000, 1 million jobs, that's where the markets start to kind of perk their ears up like a dog and say, hey, is something going on here that we should know about, that, companies are not looking to hire as many employees. So that data is going to be absolutely huge on Tuesday. You will have Fed Bowman at 10:10 in the morning, Fed Williams, Fed Master, and Fed Daily, all at about noon. Fed Daily does speak at 1:30 p.m. though. And that's pretty much it for Tuesday. For Wednesday, you will get the ADP employment change at 8:15 in the morning, expecting 130,000 net job ads. That's the closest thing comparable to the Friday non-farm payroll report. So it's something the markets will pay attention to. So keep that in mind. You will get Fed Bowman that speaks at 9:45 in the morning. ISM Services PMI will also come out at 10 o'clock in the morning, expected to come in at 52.6, the same as last month. ISM Services new orders and prices paid are going to be the most important. You're actually expecting both of these to fall a couple points. As long as that happens, great. If ISM service prices increase, that's obviously bad news for inflation. You will also be getting a speech from Fed Jerome Powell on Wednesday, and that'll be important. That does come out at about noon on Wednesday. I'm not expecting much of a change from Fed Jerome Powell. He kind of said the same thing over the weekend on Friday as he said at the last Fed meeting. He is a full-on bull. Powell is bullish. Now, Thursday, you are going to get initial jobless claims, balance of trade out of Canada. That's highlighted in red, expected to be a big catalyst. Fed Kugler that speaks, and this new guy, I don't know, I think he's a new guy. I've never heard him, seen him on here. I've never heard him speak. Fed Muslim at 7:20 p.m. So there is that. On Friday is your big data with non-farm payrolls, expecting that number to come in at about 200,000. Again, if you miss to the downside here, that's not going to be great. That's when markets are going to get a little bit more fearful about a potential slowdown or recession coming in our markets. So you definitely want to see that come in line with expectations or even slightly beat to the upside. Would be good. You also got to keep in mind the revisions, and I know a lot of people don't like the revisions that they're so large with the non-farms, but you got to remember only about 27% of businesses are actively like giving their job data to the BLS, and the rest of it just kind of comes in with a huge delay. So that's kind of why you get those big, downside revisions. We'll see if that happens to last month's number, but the revisions are getting larger. And, maybe the situation's not as good as we think. So we'll get more clarity on that on Friday, as well as the unemployment rate expected to come in at 3.9%. You did see a big jump last month to the highest level that you have been at since, I believe, like early 2021. So that was not great. If you do rise above 4%, that's going to be not great either. And then a lot of secondary data that goes along with the unemployment rate and the non-farms, participation ratio, government payrolls, average weekly hours. All of that will be important to pay attention to. And then some Fed speakers throughout the day on Friday. Fed Barkin at 9:15 in the morning, Fed Bowman at about noon. And that is pretty much it for your economic calendar. And it seems like these days, every week is earnings or an earnings week. And on Monday, you're going to have PVH and Canoe. Tuesday, you're going to have Paychex Pre-Market, Dave & Buster's, Kane Main Foods as well, Tuesday and after hours. Blackberry, Levi's, Sportsman's Warehouse, RGP, Wednesday and after hours. And then Conagra Brands, Thursday Pre-Market, as well as some other less notable names, Thursday as well as Friday. In about 2 weeks, you are going to be getting larger earnings that will start with mostly your banks. You will get Tesla and Netflix and some of those stocks as well that do tend to report first for your big tech. And depending how those earnings come in, that is probably what is going to drive the markets either higher or lower from here. I find it hard to believe markets are going to go higher from here just because they're so much baked in to our markets. Expectations are very high. Things have to pretty much go perfectly to justify the markets trading at over 21 times next year's earnings. I mean, that's expensive. That's not cheap at all. You're not getting a deal on your broader S&P or triple Q indexes. Markets are currently pricing in a 34.9% chance of 3 rate cuts by the end of this year. But again, it does feel like to me Fed Jerome Powell is looking for any excuse he can possibly find to start cutting rates. Over on StockTwits, ticker symbol SPY, probably what you use to track the S&P 500, sentiment right now is at 58, which is bullish. Yesterday was at neutral, right at about 50. So on this Sunday, people are pretty bullish on the S&P 500, which could be to some degree a contrarian indicator to say, if people are super bullish, then maybe we do get a sell-off here soon. Keep that in mind. You have now hit almost a new high for investors that are bullish here on the AI Investor Sentiment Survey. 50% of investors are bullish. 27.6% of investors are neutral. That is down about 2% from last week's survey. And only 22.4% of investors are bearish. That is down about 5% from last week's survey. Bullish investors up almost 7% from last survey. So people got a lot more bullish last week, likely following the speech from Powell, kind of that reiteration that he's still bullish. We did also get some good news over this weekend that China's March data for factory activity expands for the first time in 6 months. The official Purchasing Managers Index PMI rose to 50.8 in March from 49.1 in February. Anything higher than 50 is expanding, positive activity, positive growth. Anything less than that is contractionary. So this is some good news for anyone that is hoping for China to rebound. This is actually interesting. In the SPY, ticker symbol SPY, again, what you guys probably use to track the S&P, short interest is 10.22%. It's actually pretty high, but it's been falling a lot over the last couple of months. It's down 46.1% in the last couple of months, down from 17, 18% or so, which again would suggest relative to the last 18 months, people are not positioned to hedge for any downside here. 10% short interest sounds extreme on the broader S&P 500, and I believe by any account that is still pretty high, but you're a lot lower than where you have been over the last year and a half, which leads me to believe that people are not hedged for that downside. Now, what does that mean? Well, hedge funds, institutions, market makers, specifically market makers, people that are creating the market, they like to kind of do the switcheroo on people. That's why if stocks are just continuing to go parabolic, inevitably you typically see a correction. If stocks are just crashing, you normally see a correction to the upside. As soon as everyone gets bullish, that's usually when stocks fall. When everyone gets super bearish, that's usually when stocks rise. That doesn't happen for no reason. A lot of it has to do with positioning. And if everyone is bullish right now, that could set you up for a downside move. If we take a look at the triple Qs here on the chart, I'm really watching this channel that we are in, this what looks like a bear flag pattern. Now, if you break under this line and get any kind of substantial close under this line, that could set you up for a larger move lower. Now, technically on Friday, you did close under this line, especially given what happened towards the end of the day where you kind of flushed down to hit a new low of the day, bounced up quite a bit and kind of traded sideways in after hours. If you do end up closing under this line heading into tomorrow, well, that's not going to be a great sign for the bulls that want to see the markets continue to go higher. Next stop would be around 438 on the triple Qs. And then next up, you're going to be looking at your moving averages here. 50-day, 100-day, and 200-day moving average. 50-day moving average right in the low 430s, around 433. 100-day moving average at 413. And 200-day moving average at about 389, almost 390 or so. So those are the levels that I would be watching for. Again, JP Morgan did come out with a new note on Thursday as well that stocks could crash for no reason, that we could see a 20% pullback from here, which would take you back to the October, November lows by the end of this year. I personally don't see that happening, but a correction here makes a lot of sense and would likely be healthy. So from my perspective, you're very vulnerable here. I would not be long. Would I be short? Would I have some put protection on my portfolio? I think that makes sense, but I think really timing's the issue. Premiums are pretty cheap. You can get protection for pretty cheap right now because everyone's seemingly bullish, but there's no timing specifically when you could see a correction. It could definitely start this week, or it could start 8 weeks from now. I think earnings are going to be a big catalyst. If earnings do come in weaker than expected, that's going to be really bad news for our markets. So with that said, hit the like button, subscribe to the channel. Let me know what you think about this information down below in the comment section. Thank you for watching. Enjoy the rest of your day, and I will see you in the next one.